All right, Lane, thanks for joining me. We're here to talk about the new SBA SOP, but first, could you tell everyone who you are, who you're with, and that'll probably answer why I'm so excited to have you with me today.
Joe, yeah, I am Lane Rhodes. I am a senior lending officer over at Live Oak Bank. We're a bank that primarily focuses on SBA lending. We have no brick and mortar offices, so I work out of my beautiful home in Nashville, Tennessee. Very lucky to be in the great city of Nashville, which is booming right now.
Absolutely. So, Lane, I know there's been a lot of changes to the SBA SOP. I think, at least on the exit planning side, a lot of us are like, oh my gosh, what are all these changes? I looked at the SBA, like the changes itself, I'm like, this is very dense. But the Live Oak website, and I can make sure that the blog post that you guys have is linked here, does a really good job of breaking out some of the new changes. But could you tell us what's changed in the new SOP? What do we need to know?
Yeah, so SOP, the SBA loves their numbers. So it's SOP 5010-8, not to be confused with the last one that was 5010-7. But 5010-8 basically goes back to what the guidelines were prior to the last administration. So every administration that comes in obviously wants to put their spin on, the small business lending programs. We got a little bit of ways from kind of what we would call in the banking space just solid, prudent lending practices. And one of the biggest changes was kind of waiving some fees for the program, which actually caused last year for the first time in a long time for the program to lose money. And so, in the eyes of a lender who wants these programs to be around forever to serve the needs of the community, we really needed to kind of get back and refocus the program to what it really does best and go back to those fees again. I definitely agreed with some of the fee waivers that were put into place during COVID. They saved a lot of businesses that wouldn't be around today had they not been in place, but they didn't need to be permanent. So we're just kind of going back to pre-COVID, SBA lending policies, which for me, having been in the SBA lending space for a little over 20 years, I mean, it's kind of getting back to the old school rules and regs that I've known for many, many years doing SBA lending.
So is it fair to say that this isn't a major overhaul, but more of a return to former standards, it sounds like?
It was just because, a lot of the changes that were put into place under the last administration was a huge overhaul of the program. So since I've been doing SBA lending, it only financed 100% ownership changes. It didn't do partial ownership changes. So partial ownership changes were something that got changed under the last rule change. Now they're kind of rolling back some of those, but there is a pathway to still be able to do them under this new reg. So that's nice that there's still a pathway forward. Now, it might not be a pathway that works for everyone, but there's definitely a pathway there should an owner not want to sell 100% of his business and be able to utilize the SBA program to do that. Just kind of quick highlight, some of the changes are, going back to the 10% equity requirements. I think that's important as well because leveraging a transaction at 90% is already really leveraging a business at a lot higher than what most people would recommend. So being able to leverage it at more than that under the old guidelines was really kind of what was causing some of those losses in the SBA program. They were seeing lots of defaults. Collaterals required again on the small loans. That's not a huge change to kind of go back to. We are requiring hazard insurance again on loans of 50,000 or more. That's pretty standard in commercial banking across the board. So I don't know why that was, kind of rolled back under the last administration. Like I said, going back to the SBA fees. So prior, they were waiving all of the fees on all loans under $1 million. Well, the bulk of the loans done using the SBA program are under $1 million. So they were essentially waiving the fees on like 60% of the loan volume they were doing. That's not a sustainable model. So we went back to implementing the fees. And then, part of the big push under this administration is supporting manufacturing job. So I think we're going to see some even more changes coming down the road that could be really positive, impacting manufacturing type businesses here in the US.
Great. Thanks, Lane. And so, with all these changes, I guess, we're always talking about common SBA deal pitfalls. It sounds like some of the changes are probably going to increase the quality of the deals, perhaps, is kind of what I'm hearing from you. Are there kind of new pitfalls that we should be aware of? What do you see as a common pitfalls going forward, essentially, after the changes?
Yeah, so some of the pitfalls that we were seeing right when these got implemented into place, which everything went into effect June 1st. So we're really early into this. So we're probably going to see more things come about as we get more into it. But the biggest change for me was having to document 100% of the ownership as being US citizens or lawful permanent residents. So, before we were only having to document 81% of the ownership. Now we're having to document 100%. And where
Mm,
that really comes into play when dealing with acquisition type financing in the ETA community is when you're raising a group of investors. And if you have a fund that's investing, direct ownership and indirect. So if they have a fund that's investing in them, I then need to know the ownership makeup of that fund. So it's going down that rabbit hole and capturing 100% of that. So if you have somebody that's an investor in a fund that's in Germany and you're getting an investment from that fund, that makes you now ineligible for an SBA loan. So that's a pitfall that people need to realize when they're out there raising equity. They need to make sure that 100% of the equity that they're raising is a US citizen or a lawful permanent resident. So that's probably the biggest pitfall. Joe, one of the biggest kind of pitfalls that I see people, potentially could be running into is some changes that were made to the SBA around the liquidity of the buyer coming in, the borrower or buyer, whatever we want to call them. But their balance sheet does come into play. And if they're too wealthy in the eyes of the SBA, they may be ineligible for SBA. And one of the things that we used to have several years ago under the SBA was something called the personal resource test. That test technically has not come back. However, the SBA has let us know that that would be a great tool and guardrail for us to use if we were looking for a good way to determine if somebody was maybe too wealthy for SBA. And so basically what that resource test looks at is when we're looking at a personal net worth of somebody that's going to be a 20% or more owner. So people that are under that, this doesn't apply to them, but anybody that's going to be a 20% or more owner, we're looking at their personal balance sheet to see, do they truly have liquid assets of 1.5 times what they're looking to borrow? And if they don't, then they're all good. They've passed the test. If they do, we need to kind of dig into those assets and say, okay, well, what could they potentially need these for? Retirement is one, kids, college savings and stuff like that. That's also one. So there's definitely things that we can deduct from those. But bottom line is, if we look at somebody's balance sheet and let's say they have 5 times the amount of what they're trying to borrow in true liquid assets on their balance sheet that's not tied to retirement, it's not needed for, kids' education, those sorts of things, then we're probably going to either make them put a higher injection into the loan, or we could just say you need to utilize these funds to go pay cash for the business or find a better conventional route. A lot of times, if people do have a lot of assets, there may be a better path for financing for them than using the SBA lending program. But that is a pitfall that's kind of come back into play that wasn't there under the last administration. Same with the 10% down payment now. That can be a pitfall now for people that are going to have to go out and raise equity. We were using seller notes prior to the most recent rule change. Now a seller note can count for 5% of your down payment or 5% of the cash needed to come in. So half of that 10% can be in the form of a seller note and count towards your equity if it's on full standby for the life of the SBA loan. So if you're doing an SBA loan to buy a piece of real estate and it's going to be a 25-year loan, that means that you need to convince the seller to give you a 25-year seller note that's on full standby, meaning no principal and interest payments for the 25 years. Now, what's going to be more common is a 10-year note, getting the owner to do a 10-year standby agreement. But what I do like to qualify with that is you can still do seller notes and have them paid back day one if they're not counting towards your equity. So what's very common in a pitfall that, I see from people that we can easily avoid is if the seller note's not needed for your 10% equity, then it doesn't have to be on one of those standby agreements. As long as the cash flow can support it, we can start paying it back day one. So it's very common for us to structure a loan that would maybe have two seller notes. If the seller's willing to do the standby on the one that's needed to be counted for the half of your 10% down payment, then do a seller note that's on standby for that percentage. And then a second seller note that would get paid back on whatever terms you guys agree upon. That note is completely eligible, does not have to be on standby. So I've seen some kind of misinformation out there around that all seller notes have to be on standby, and that's not accurate either. It's only the seller notes that are being counted towards that equity injection. Another thing that's actually holding up closings right now is as the franchise registry is back, which that's a big clap from the lenders on that one. We're really excited that that's back, but that means that a lot of franchises are not up to date on the registry. So we were encouraging franchisees or franchisors to actually go get on the registry prior to this going live. A lot of them did not do that. So we're now having to wait for them to get updated in the registry for us to be able to close on the loan if it's a franchise business that you're looking to buy.
So seller notes, they're not dead. Franchises still in play. So all of these things are still SBA eligible. What are some pro tips that you have? You're a 20-year veteran in the SBA space. What are some of the proactive things that buyers and sellers, I guess especially in my mind, what sellers can think about as they like, I might sell in the future, how these SBA rules affect me? Because I think, sellers want to prep so that's the most sellable business possible. With the SBA rule changes in mind, are there any kind of pro tips you have prepping towards a sale and an acquisition?
Yeah, definitely. A well-prepared seller is going to get a higher value for their business. So, clean financials, number one. I mean, having a clean balance sheet and income statement, that's an absolute must, but you would be surprised at how many sellers we work with where their balance sheet doesn't balance. Or their financials, they only update them quarterly, or sometimes even, they actually don't even update them till the end of the year when their CPA is asking them for all of their information to do their taxes. That's not going to work in an SBA transaction. We need financials that are current. The SBA says they need to be current within 120 days, but most lenders want to see them current within 60 days. So, at a bare minimum, your financials need to be current at 120 days, but for most lenders, you want to have them fairly current within the last 60 days. Another thing right now, and I was actually talking with several business brokers a couple of weeks ago, and they're seeing this same trend, which is a little disconcerting to me, is we're seeing that year-to-date numbers in 2025 in a lot of businesses are trending under where they were in 2024. So we're always going to do a look back. So if we're looking at first quarter 2025, we want to see how that compares to 2024. And if it is trending down, we need to know what's causing that. It doesn't mean that we can't lend money on that business, but it means we really need to understand what's going on in the company. 24 may have just been a banner year for them that wasn't going to be achievable again.
Right.
And as long as we know that and know the mechanics that cause that, that's going to be fine. But what we don't want to see is, declining trends in the business and then the business and the owner not have a great understanding of what's causing that in their financials. Another big thing that I see is lots and lots of add backs from the seller. They're running the business like a lifestyle business, and they're running so many different things through the company. If they can get those cleaned up, a year ahead of time, that would really be beneficial. But if it's an instance, which we see a lot, somebody's in bad health, they need to sell their company, they didn't have the luxury of working with a good advisor like yourself for several years to be able to kind of get the business ready to sell, we're happy to look and entertain those ad backs. We actually partner with GCF Valuations, and they'll do an ad back tracing for us because the bank doesn't have the bandwidth to go and validate that every ad back is legitimate. And we do have to do that. So the SBA program is a taxpayer funded program. Because of that, we're underwriting to the tax return. So if I cannot foot those ad backs back to the tax return, I cannot include them. So that's why the ad back tracing is so important. They'll go in and actually, look through the company's financials. They'll look through the bank accounts. They'll look through receipts. They will give us a paper trail that is provable to the SBA so that we can foot all of those ad backs back to the tax return. But that can take time as well. So I actually got a LOI on Friday from a client that was giving him 30 days due diligence period. It was a company that had a 3-page list of ad backs. That's just not going to give us enough time, unfortunately, to get through that amount of ad backs. So that's another thing that, I think sellers, if they could realize, if their business model is a little bit more complex and they do have a lot of ad backs, they're going to need to be comfortable knowing that the due diligence time period from the buyer's side is probably going to be longer than 30 days. And so just, giving a little grace there, realizing that it's not the fact that the person looking to buy the business isn't qualified and can't get financing. It's more of that to get the financing and hit that number. That's what I always go back to the sellers. I'm trying to hit that number for you so that you can maximize your enterprise value and we can finance more. The other alternative is just to not include those backs, and then what we can finance goes down. I always like to qualify that from the lender side. We are never here to tell the seller what his company is worth. We're here to tell you what we can finance on it. And if you're looking at a buyer that needs financing, you're going to need to take that into mind when setting the purchase price for the business and who your qualified buyers are. If it is a business where we cannot leverage the company at 90% under the SBA guidelines, your buyer probably isn't somebody that's coming in with a minimum 10% down as well.
And one of the things I love about working with lenders like yourself is that you're right. You're doing what is the bank willing to lend against, but I also think that's a very good proxy for banks are very diligent. They're looking through these things, and understanding what a bank will lend against it is a good measure of a business's health and how quickly that deal can move through. A lot of owners will tell me, "Oh, well, Joe, I don't want to talk to you right now." 3 to 4 years down the line. But if it's a choice of, sure, great, but you can talk with me, learn about the process, and for the next 3 to 4 years, get your books in order. Make sure if it's a lifestyle business, I get that, but it can be organized because you're either going to be nice and organized, marketing something that's organized, or 30, 60 days diligence. We need GCF to come in. We need, the buyer is now like, well, I don't know about this. And now your price is moving around. And so that's a great tip and insight of what happens at the end if you don't think about it proactively.
Yeah, key employees are also a big one for us, So if it's a business where the seller is keeping all of that knowledge and they haven't been able to transfer that down to another employee, that's going to be a harder business for us as the lender to get comfortable with because of the SBA rule that if it's 100% ownership change, that seller can only stay on for 12 months in a 1099 contract position. So they cannot stay on as a W-2 employee in any circumstance. They always have to go to being a 1099 contract employee. But if it's 100% ownership change, they can only stay on for 12 months. That has been the rule since I started in SBA lending many, many, many years ago. So it's not anything new, but people are seeming to think it sounds like something new because we had the partial ownership change where an owner could stay on. That is actually still there. So if the owner wants to sell his company as a stock sale, then the owner could stay on in a minority role and not have to be, fully on the loan. Now, if they are going to stay on in any level whatsoever, under 20%, they are going to have to provide a 2-year limited personal guarantee. And I know that sounds scary because that's not something that we typically have done in the past. But actually, in my past of SBA lending, I have done that before, and it really isn't as scary as what people think. A limited guarantee from the SBA means just that. They're not signing away personal assets. They are literally just on the loan for 24 months. And as long as that buyer makes 24 months of consecutive payments, that guarantee drops off at the end of 24 months. I did this when I was a lender at Regions Bank for a business that was highly, highly complex, and the seller was the only one that knew the information of the business. So him running off into the sunset 12 months after the loan closed just wasn't in the cards for this business owner. We needed to keep the owner involved longer. And so we made him a limited guarantor on the loan. And after the 2-year time period, we did just that. We dropped off his guarantee. They didn't have to pledge personal assets. It wasn't as big of a deal as what I hear out there a lot of times, but I get it. The government taking, a lien of any sort on a business owner sounds scary, but I look at it as the owners walking away typically with, 90% of their purchase price at closing that they're getting in cash. Sometimes they're still getting 100% of their purchase price at closing. And if they're only having to be on for 24 months in a limited capacity, that is a whole lot less risky than sometimes the alternative is the owner financing that deal. Well, what's going to be more risky? The owner taking back all the financing on it and being the bank, or the bank being the bank and taking a limited guarantee for 24.
Right. No, absolutely true. And I think a lot of the motivation, so if the business is strong and sellable, I think the owner usually has a lot of confidence to like, okay, I'll stick around and I'll get my cash up front, no seller financing to make that SBA deal work. But I think there's also the part where a lot of sellers, in terms of the decision of like staying involved in the business for so long or not, it was either in the cards or not. I think the sellers already kind of had a mental picture of like, well, I'm just not going to be around, or that's fine. And so I think some of those internal motivations outside of the SBA rule changes are still going to play a factor.
No, I definitely agree with you. I mean, if an owner's looking to sell their company, they're wanting to be out more than likely. There are those rare instances where it's just they're tired of dealing with maybe managing employees and they just want to do the business and not have to be the manager. And so that's kind of a lot of times where I see this potentially, being used as still a really good alternative, but another thing that sellers can do to kind of help prep themselves and maximize the value is eliminate any customer concentrations that are over 20 or 30% as well. We've seen a lot of deals lately that have had really, really big customer concentrations that we've been able to come up with creative structures for financing, but that doesn't mean that we were able to convince a buyer that they were comfortable taking on that risk of the concentration. So there are creative ways from a banking standpoint that we can hedge against those and structure a deal. But the bigger hurdle is convincing your buyer that that concentration isn't a risk to them. And from the bank's perspective, how we view customer concentrations, it's not the risk that buyer comes in, buys the company, and that customer doesn't continue doing business with the company. The risk is that company that makes up the concentration gets bought by somebody else. Something that's outside of the control. Those are the risks that we're worried about. It's not that customer isn't going to still stay with the new buyer. They wouldn't be buying the business if they didn't believe in the product that was being sold and the value that they're adding, those sorts of things. It's more of that economic risk that they don't know about that could cause that customer to go away by no fault of the current owner has that risk, and the new owner would inherit that risk. And so the way we kind of get creative in hedging that is there has to be a sharing of that risk going forward.
Well, I love what you're saying about how to be prepared and the new SBA rule changes. Because what I'm hearing is that from the seller perspective, it's still do all the things that you should be doing anyway, regardless of rule changes, right? Clean books, lower your risk of customer concentration, lower your owner and management risk. All things that were true yesterday are true
Yeah.
today. And then if you have that really strong business that's very sellable, then you don't need to worry about SBA rule changes. People are going to want to make that deal happen. Okay, Elaine, closing thoughts here. 20-year SBA veteran, Live Oak Bank, which I know does a lot of great deals. What are your parting thoughts for people?
Yeah, I mean, I just wouldn't be scared of these changes. And I would also like quiet the noise that's going on out there. There are so many different opinions of the SBA program and when to use it, when not to use it. It's not going to be the right fit for everyone. So making sure that you have somebody that is a good advisor. I'm the first person when I sit down with buyer and seller that if the SBA program's not the best fit for them, I'm going to tell them very quickly. You never want to, be trying to jam a square peg into a round hole. Like that's just not the way to do this program. If you don't fit, you don't fit and you don't need to use it. But there is a lot of flexibility to the program that somebody that's new to it or even got into the SBA lending just a few years ago when we were under the old rule changes, they may not be as agile and understand proper deal structuring and how to really utilize the program to its fullest. So all SBA lenders are not created equal. Make sure that you go with somebody that, really understands the program. Don't be afraid of it. Let your banker make sure that everything is eligible. That's the job of the banker. You spend time, buyer and seller, making sure that you both feel comfortable going forward with this transaction. Because that's the most important thing, that the buyer and seller have great chemistry together. If they don't, we're going to see deals blow up regardless of what the financing is, regardless of how much of a down payment somebody can come in with. If that chemistry is not good between buyer and seller, all bets are off at that point in time. So I'm a big proponent of getting people together earlier in the process versus later in the process. I just think that, open lines of communication, there's just no alternative for that. And your lender should be happy to jump in and talk through those things as well. The worst thing I can do is work with a buyer that comes to me after they've already gone under LOI. That they're under isn't financeable under the terms that they've already agreed to with the seller. That's the worst time to bring your banker in. But honestly, a lot of SBA lenders out there, they don't want to work with somebody until they know it's a deal and they're under LOI. So, make sure you ask your lender, are you okay looking at, 10, 20, 50, sometimes even more than that. I mean, I've got customers I've been working with for, 6 years that still haven't executed on a sale, but I will pick up that phone every time they call and kick the tires on a deal with them to see if it's a good fit and make sure that we're structuring it appropriately on the front end before they go under LOI. Because I never want them to have to go back and renegotiate the deal after they've gone under LOI. That makes them lose credibility. The seller's not going to have as much confidence in the deal closing if you're having to go back, just days after going under LOI to start renegotiating, part of the original structure. So get a lender involved early and often is my pitch to people out there looking to buy a business and use SBA.
And the open lines of communication, like you said. So if there's things that need to be discussed, which there always are in a deal, you need to go back and forth. But like you said, if there's open lines of communication, that builds trust. And then it's not the SBA program that's going to be the issue. It's going to be, is this a good business? Are we working together? And I'm sure if those two things are in alignment, you and Live Oak that financing piece will fall in very easily.
Yeah. I mean, it's not a hard program. I mean, I actually like these new changes because it went back to putting guardrails in place. And everybody wants to know what the rules of the road are. If they know the rules, you can follow them. And guess what? You execute on transactions quicker, faster, better. Under the old rules, they had, called do what you do from the bank standpoint. Well, that basically gave banks a lot of leeway, which honestly caused banks some to get real aggressive, but a lot of banks just pulled back. because those guardrails were taken away, and they didn't really know that if a loan went bad, do I have an SBA guarantee on it or do I not? That's what we want to know. We want to be able to say with 100% certainty when we close on a deal that we've got our SBA guarantee intact because we followed the letter of the law, we followed the SOP, and we made the right decisions, per the guidelines of the program.
Right. Well, Lane, thank you so much for your time and your insights, and to Live Oak Bank for all the work that you're doing in the space and the good content. That's clear. Appreciate everything that you're doing.
Well, thanks so much, Joe. We appreciate you letting us come on this afternoon. And like I said, you're tracking with our social media and our updates that we do. But anytime there is a change, we will be really quick to get an update out there to everyone.
And there will be changes. And Live Oak
Yes,
is where you can see what's going on and get some good insight as to what they all mean. Great. All
absolutely.
right. Thank you, Lane.